Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. ESG ETFs, a smart guide to sustainable investing in 2025. More investors are putting their money where their values are, and ESG ETFs make it easier than ever. These funds bundle stocks or bonds from companies that meet strict environmental, social, and governance standards, letting you grow your portfolio without sacrificing your principles. As climate concerns and corporate responsibility take center stage, ESG investing has moved from niche to mainstream, with global assets in these funds now surpassing $2 trillion. Whether you're new to sustainable investing or looking to refine your strategy, understanding ESG ETFs can help you align your finances with the future you want to see. Understanding ESG ETFs. ESG ETFs take the best of traditional ETFs, diversification, liquidity, and low costs, and add a sustainability filter. While traditional ETFs track broad market indexes, ESG ETFs screen investments based on environmental, social, and governance performance. This means every company in the fund must meet specific ethical benchmarks before your money touches it. Think of it like shopping for produce. Instead of grabbing any apple off the shelf, you're picking the organic, fair trade options. What sets ESG ETFs apart from traditional ETFs? Traditional ETFs focus purely on financial performance, tracking indexes like the S&P 500 regardless of a company's impact on the planet or people. ESG ETFs flip the script by using strict screening processes to shape their portfolios. Negative screening excludes industries like fossil fuels, tobacco, or firearms. If a company's core business harms society or the environment, it's cut. Positive selection actively chooses companies leading in sustainability, like those using renewable energy or promoting workplace equity. Best-in-class approach. Even in controversial sectors, ESG ETFs may include the top performers in ethical standards. For example, an oil company with strong emissions reduction goals might make the cut. The result: a portfolio built for long-term growth and positive impact without sacrificing returns. Key ESG criteria in ETF selection. Every ESG ETF weighs 3 pillars: environmental, social, and governance. But metrics vary. Here's what fund managers scrutinize: environmental carbon footprint, energy efficiency, waste management. Example: a solar panel manufacturer scores higher than a coal producer. Social fair labor practices, community engagement, data privacy policies. Example: a tech company with strong parental leave policies ranks above one with labor violations. Governance, board diversity, executive pay equity, anti-corruption policies. Example: a bank with transparent lobbying disclosures gets priority over one with misconduct scandals. Funds may also integrate SDGs, UN Sustainable Development Goals, prioritizing companies tackling poverty, clean water, or gender equality. Bottom line: ESG ETFs don't just avoid harm, they push for progress. The benefits of investing in ESG ETFs. ESG ETFs don't just check the box for sustainability, they offer real advantages beyond feel-good investing. From aligning with personal ethics to competitive financial performance, these funds prove you don't have to choose between principles and profits. Aligning investments with personal values. Investing shouldn't mean compromising what you stand for. ESG ETFs act like a financial mirror, reflecting causes you care about, whether that's clean energy, racial equity, or transparent corporate leadership. Here's how they bridge the gap between money and morals. Climate action. Funds focused on environmental criteria steer capital toward companies cutting emissions or pioneering green tech. Your portfolio directly supports renewable energy over fossil fuels. Social impact. ETFs emphasizing social factors invest in firms with fair wages, diverse leadership, and community programs. Your dollars back businesses improving lives, not just bottom lines. Accountability. Governance-focused ETFs avoid companies with shady ethics, lobbying ties, or executive pay gaps. You own shares in workplaces that operate with integrity. It's voting with your wallet without sacrificing diversification or liquidity. Performance and risk considerations. Critics once claimed ESG investing meant settling for lower returns. The data tells a different story. Studies show ESG ETFs often match or outperform traditional funds while lowering risk exposure, returns. Research from Morningstar found 58% of sustainable equity funds ranked in the top half of performance over a 3-year period. Companies with strong ESG practices tend to innovate more and face fewer lawsuits, advantages that show up in stock prices. Volatility. ESG ETFs historically weather market downturns better. A 2023 Morgan Stanley report noted these funds had 20% less downside risk during corrections. Why? Firms with responsible practices avoid costly scandals and regulatory fines. Long-term resilience. ESG metrics spotlight companies prepared for climate regulations or shifting consumer expectations. Think of it as future-proofing your portfolio. Of course, not every ESG ETF outperforms. Fees and strategy matter, just like with any investment. But the myth that ethics mean weaker returns is fading fast. How to choose the right ESG ETF. Picking the perfect ESG ETF isn't just about ticking a sustainability box. It's about matching the fund's strategy to your financial goals and ethical priorities. Some funds focus on carbon reduction, others on gender equity, and some blend both. The key is digging into the details before you invest. Assessing ESG ratings and scores. ESG ratings act like report cards for funds, grading companies on their environmental, social, and governance practices. Agencies like MSCI and Sustainalytics use proprietary algorithms to score thousands of stocks, but their methods vary. MSCI rates companies from A leader to CCC laggard, evaluating things like carbon emissions, labor standards, and board independence. Sustainalytics assigns a risk score, lower is better, flagging controversies like oil spills or workplace discrimination. What this means for you. AA-rated ETFs lean toward market leaders in sustainability, often excluding entire industries like fossil fuels. BBB-rated ETFs cast a wider net, including companies making progress but not yet top tier. Watch for greenwashing. Some funds have high ratings but weak standards. Always check the underlying holdings. That wraps up Part 1. Stay tuned for Part 2 for more insights into sustainable investing with ESG ETFs. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.